Hey team, we're looking at we're looking at job costing today. We're going to compare that with process costing and get our heads around some journal entries. Let's go for it. See what we can discover. So let's do it first up. What's the distinction between job costing and process costing? You most likely have been a client in a job costing system. If you've taken your car to the mechanic, you're the client, your name's on the job card, and as component parts are added for the job, and so labour and parts are costed out and charged to you. That forms the basis of the invoice that you'll be charged for that particular service job. On a very, very small scale, when you go to Mr. Minute at one of the shopping centres and get some keys cut, it's a job costing system, materials, labour charged to you, the client. Very, very simple, but it's still job costing. Whereas process costing, anytime you get a product going through a process, sugar refinery, oil refinery, paint manufacturing, we're producing orange juice or Coca-Cola, chocolates. Nobody's name is on that Coca-Cola bottle or can, or perhaps it is, but that's just all part of the marketing. But you, the client, that job on that product on the conveyor belt is for the market as a whole. And so the journal entries there is some similarity, but there's a different way of allocating costs in the process costing system. So, but today focusing on job costing. And we're going to look at the distinction between actual costing and normal costing very briefly. How do we apply our overhead costs? So look at doing that today. And then most of the time we really do want to, at the end of the day, we'll be working through some detailed questions in class. And we want you to be comfortable understanding the journal entries, recording the flow of costs in our job costing system. And we will also have to work out what to do, how to allocate these under or over allocated manufacturing overheads. So there's a couple of ways of dealing with that, more of that later. So so again, just giving us some examples, the wedding planner is working for you, the client. The accountant, the lawyer, the legal firm is billing their hours to you for the work they're doing on your behalf. Aircraft or advertising. So all job costing, process costing, they've given us a range of mass-produced products. Think of something on the conveyor belt, as we said, and you've got the idea of the difference between the two methods of costing systems. Not just limited to the process costing, not necessarily just limited to the manufacturing centre. So here we go. Could be also, the process of handling checks or clearing checks, or this is a service, but the postal delivery is still running with process costing there. Again, in the service sector, so we've got job costing going on with your legal firms and accounting firms and your architect and whatever, dentist. So you can read that straight from the textbook. That's good. So what are we doing? We've talked in week 2 about the idea that we will be attaching, we've got these product costs or inventoriable costs. Costs are attached to the stock item, if you like, the product. So direct materials, those major component parts that are easily or economically tracked and traced to the product. Same with your labour hours, the people that are directly involved in working on, the production process, their hours are charged directly to the product costs. But we've got all these other costs, the supervisor's wages, he might be supervising a range of different products. So we're going to share his that overhead cost amongst a range of products. And the same with, there'll be some indirect material in there. We talked in week 1 about the glue, the sandpaper and the oil really can't be tracked to the product. We'll throw that in when it's ordered as one of our overhead costs. So, the rent of the factory, the security guard wages, the forklift driver, all those sorts of costs of, running the factory will be allocated. And we'll work out how to do that. Both those fixed and variables, they're applied, and we'll see that in the next few slides. So we're going to create a job cost card or account, if you like, for the client, and we'll be tracking costs for that particular job. And we're going to work out the best way and the fairest way of allocating our overheads to the job as well. So the first thing we might do, at the beginning of the year, work out our budgeted manufacturing overhead costs perhaps, and then sit down and work out what is the best way of allocating those costs. So divide the dollars by whatever the activity level is down here, and we've got a rate. So, $100,000 worth of overhead costs, and I don't know, 10,000 direct labour hours perhaps, so we'll be charging it at $10 per direct labour hour, as perhaps we might think that's the fairest way of allocating our overheads to the job. So this is telling us exactly that. Once you've got your rate, multiply it by the actual activity to charge it to the job. Here's a quick look at a typical sort of job cost record, job number, the customer's details, the date, and then we list what items were required to complete the job. So the materials are added and costed out, and also from the timesheets we can work out what sort of hours have been allocated to the job at different rates, and calculating it up, and then we're applying some overhead based on direct material manufacturing labour hours. So based on those hours, we've worked out our activity is $30 per hour, so we charge out our overheads, $30 times the 55. So my $16.50 will cover the overhead costs. So the job so far, until it's charged to the client, there may be more materials and labour to be added, but at this point, the value of the cost to the client will be $5,497, and that will form the basis of us of our invoice to the client. We may also build in a profit figure. There might be markup on top of that. So it just depends how we allocate, how we're working with this our overheads. So here we were looking at our budget, getting our overhead costs, $210,000. We've decided that the best way to allocate those overheads did seem to be manufacturing hours. So divide our dollars by our activity, and we've decided $30 per direct manufacturing labour hour is how we'll charge and allocate the overheads, and direct materials, direct labour being tracked and charged directly to the job. Well, we could use normal costing. Most businesses would use normal costing, where we track and trace actual direct cost to the product or the job, and we allocate the overhead cost based on budgeted figures. And we've predetermined that, we've worked it out at the beginning of the year. That's normal costing. Most of our questions will be relying on normal costing. And the distinction between actual costing is that's the same, charging actual direct costs, that's fine as normal costing, but we're actually charging our indirect costs. Sorry, we're using actual indirect costs and actual quantities to allocate it. And the difficulty with that is at the time of the job, particularly, at the beginning of the year, how do we know really what the actual indirect costs will be by the end of the year? So we could have some issues there. And if we're really going to do it, we have to wait till the end of the year before we know what our real actual indirect costs all up would be. And so it could work potentially if you had a long contract, like a shipbuilding contract that's running over a 2 or 3 year period. You may not bill the client until 6 months down the track and 12 months, and so you could just be billing every 3 months based on actual costs incurred all up at that time. So the journal entries, they should reflect what's going on with our stock and the flow of products through the process, if you like. So let's track it. I think that's happening. This is some revision. We saw this chart back in week 2, and it's helpful because it helps us see what's going on in the production process. So we've got some raw material. We've got the raw material warehouse, for example, and we're buying in component parts. So this entry is not much different than what you would have learnt in your earlier accounting subjects. So we're under a perpetual stock system. When you buy stock in, debit the stock account. So debit raw material control account. I'm calling it control accounts. It's like a summary of all of the different, there could be thousands of component parts in our raw material warehouse. But they all add up to this summary card we'll call raw material control. So all of those will be, if we bought $73,000 worth of raw materials, this stock is increasing, increase asset, debit. So we would debit raw material control and credit, say, accounts payable. If we track all the movements as stock is leaving the raw material warehouse and being shipped or issued to the production, the factory, the production process, we're going to be tracking that as well. So as it flows out, the stock in our raw material warehouse is decreasing, so we'll need to credit it. And this stock, work in process stock in the factory, is increasing, increase work in process. So we debit work in process and credit raw material control for the 76,000. There will be perhaps a warehouse manager or managers that will be responsible for the value of stock, could be millions of dollars worth of stock in the warehouse. And at the end of the day, we should be able to do a stock take and verify that, yes, based on our records, we think there should be $8,000 worth of stock in the raw material warehouse. And these guys are accountable to there will be, and human error will occur and there will be perhaps some stock losses, but we want to get as close as we can to that. And these guys will be, held to account should there be a major deviation from the actual stock to the stock in our accounts. So here we are in the factory. So we've dealt with that one. We'll walk through this all these entries again in a moment. But when we buy the stock in, debit raw material control and credit accounts payable. When it's issued, credit, where's it going? It's going out of here. So credit raw material control and debit where it's flowing into, debit work in process, credit raw material control. We're going to have a couple of extra accounts to deal with our labour and our overhead costs. We'll look at those accounts in a moment, but I'll just focus on the stock at this point for a moment. As stock leaves the factory and is transferred to the finished goods warehouse, the entry will be this stock's going down. So we'll need to credit work in process stock and debit finished goods stock. So that will account for that 104,000 there. Debit finished goods, credit work in process. Increase asset debit, decrease asset credit. Nice flow through there. Journal entry hopefully will be straightforward. As you visualize the flow of, costs through the system, that will help you with your journal entries. Same sort of deal here. The production managers will be responsible for tracking the amount of the value. They're trying to minimize stock losses as well. They'll be held to account if they did a stock take and found that there wasn't that much work in process stock in the factory. So they're held to account for that. And also the finished goods warehouse managers are held to account for the stock, all these records, the flow of product through the system is being tracked and traced. And so let's work out what's happening when the sale occurs. So again, this stock decreasing, credit finished goods. And this is the time that this metamorphosis occurs between a product cost. It gets charged against the revenue at this point. At the moment, it's shipped to the customer and then the customer is invoiced. So two entries are happening here. We've got a selling price entry, credit sales, debit accounts receivable for the invoice price, and at cost price, for the same transaction, entry will be debit cost of goods sold and credit finished goods. That will fix up that journal entry. So the quick overview of the flow of costs, we're going to look at these two in the next couple of slides. But back on week 2, that enabled us, we gathered that data to produce this report, and we're able to see the cost of goods manufactured at the end. We had our direct materials, and we had our direct labour, and we had all of our manufacturing overhead costs added together, total cost with opening stock of work in process, opening stock, add the values in, minus what was flowed out must leave us, or if you like, opening stock, add the values flowing in, minus whatever's on hand at the end of the period must be the value that's of the cost of goods sold of $104,000 transferred to finished goods, and that transfers over here to our revenue statement. So a quick bit of revision there for you, and maybe go over that if just would be nice for you to cement that in your mind as well back from week 2. So let's track the entries. So we've got these accounts here. So remember, whatever's on hand here at the end of the day, this is a stock account. The balance on hand will be in the balance sheet. Same with this one. It's a stock that will end up, the value on hand at the end will be in the balance sheet, and the same with finished goods stock in the balance sheet. 3 assets there to track. And we've got these 2 accounts here, labour control and overhead control. What we'll see happening is that they're like a working account, much the same as your trading account or profit and loss account in your earlier accounting studies. Not an asset, not an expense. They're just an account to enable us to temporarily park data here while we sort out, what's going to happen with it. So, we're paying our wages, debit labour control, credit accrued payroll, and that will enable us to sort out any, PAYG tax, and there's a few other, accounting entries, deductions, superannuation, get that all sorted. But from the timesheets, we will be charging direct labour to work in process, we'll see in a minute, and indirect labour to overhead control. So the same with overhead control, actual overhead costs will be coming down, debited to this account as they're incurred, and then we'll be applying them or allocating them on this side. And we'll have to sort out if there's a balance left over, it means we've got something wrong. So more of that in a minute. Let's just focus on entry by entry, we'll build it. So we've bought some stock in. The entry was debit. You could call this, if you're looking for abbreviations for your accounts, I'll know that MC, if you write debit, DR, MC, I'll know you meant to debit materials control. Some people might call it, RMC, raw material control. So you can get away with abbreviations as you're doing your journal entries, save yourself a little bit of writing. WIP for work in process, and FG for finished goods, and COGS for cost of goods sold, and FOC, factory overhead control, if you want to use that abbreviation, or just, OC if you wanted to, or manufacturing overhead, MOC. So, and LC for labour control. So a few abbreviations we'll use in class. You can get away with using those, save yourself some writing time, and we'll understand what you meant. So the entry was, we bought some stock, debit, material control, credit, accounts payable. And now the production process, the foreman in the factory has asked for some direct materials to be issued to the job. So entry will be this stock increasing, debit work in process, credit material control. And he's also, the factory foreman or production supervisor has also asked for some wire brushes, some oil, some glue, some other insignificant, they're not major component parts, they're what we call indirect material, too hard to track directly to the process. So they will be allocated or charged actual indirect materials used, debited to the overhead control account, credit out of materials control. And then from the timesheets, we can then charge direct labour hours worked on the job. So debit work in process for those directly involved in the production process, and credit labour control for direct labour. Indirect labour will get to work in process indirectly as we apply the overheads, but firstly, actual overheads, just like indirect material, getting charged to the overhead control. So this is the supervisor's wages, and he was responsible for working on a whole range of jobs, not that specific job. So it's better to just charge a proportion of his salary to the particular job. So actual overheads being charged down here, and here more overhead costs are incurred. And these were just all those other incidental, depreciation expense on your factory plant and equipment, the rent of the factory, rate, security guard wages, forklift drivers' wages, whatever. All those other overheads are actual costs being debited to overhead control. And then based on the budget figures we talked about earlier, and actual activity, we are then applying and charging the overheads. Now, you can immediately see that there may be, we may have made some mistakes in our budget. Either the dollars were wrong or the activity were wrong, and we might be overcharging here. We could be undercharging. If we overcharge, it means our credits, of course, are going to be more than the actual costs, our debits here. And so we have over-applied our overheads. We've charged too much, and we'll have to write that back. So we'll see how we're going to sort that in a moment. If we undercharge, it means actual costs, our debits were greater than what we've charged, what we've applied to work in process up here. Then, as production is completed and the jobs are completed, they are transferred out to finished goods, waiting for the client to collect them, perhaps, or be shipped to the client. That boat that they ordered, that $2 million yacht, whatever, is ready for shipment, and we'll invoice the client at that point. But at this point, entry will be debit finished goods, credit work in process account, decrease asset credit, increase asset debit. And now we've invoiced the client, we've shipped the goods to the client, credit finished goods and debit cost of goods sold. That's at cost price. The revenue, the actual invoice price will be credit to sales, debit to accounts receivable. So we'll have the markup included there, but this is just the cost of goods sold part of the transaction here. So that is it. If you can get a feel for what's going on flowing through this system, we'll do some T accounts in class. I think I've just got to sort out, we've just got one more thing to sort out, and we'll do this in detail in class, and that is dealing with this factory overhead applied. Let's just have a quick think about if we did make a mistake here. In the ideal world, actual costs, imagine this came to 200,000 and we actually did apply exactly the right amount to 200,000. Perfect. Quite rare for that to happen, but nothing left to do if that was the case. But what if this came to 200,000 and this only came to, we'd only applied 180,000? We really haven't charged enough. And the question you've got to ask yourself is, well, where did the mistake end up? Well, it first went to here, to work in process. And then perhaps some of it's left over if there was any balance of work in process stock on hand at the end. And some of it then flowed on in here into finished goods, some of the error of this undercharge. So some of it could be sitting in here. And some of it still could be sitting in here in any closing balance of finished goods stock. And then finally, where did it end up? Some of it flowed on in here into cost of goods sold. So if we thought that the under or over applied overheads were significant, we might choose to share it, to share the error, if you like, I'm going to call it an error, between where it ended up, some of it whatever share it is. So we would actually in class, you'll see us pro rata it based on the closing balance of work in process. We'd share it between work in process, finished goods, and cost of goods sold. If we thought, you know what, it's only $1,000 out, it's only a minor mistake, the amount of balance left in work in process closing stock or finished closing stock, it's not really, we're not really understating or overstating the value of these stock items by too much. It's not worth tracking. We'll just write off the minor difference between actual overheads and applied overheads. We'll just write it off directly to cost of goods sold. So it's just get you to use your imagination here for a minute. Imagine actual costs were $200,000 in the debit balance here, and applied costs, say, $195,000. So we've got a $5,000 debit balance. We haven't charged enough. Actual overhead costs were $5,000 more. So the best way to clear this out is charge it directly to cost of goods sold. Debit cost of goods sold, $5,000. Credit overhead control, $5,000. And this will balance out to nil. The reverse would happen if we've charged too much. We've overstated the cost of goods sold, and the entry to fix it will be credit cost of goods sold and debit factory overhead control to clear out this balance to nil. Look, that's enough for today. We'll definitely, it will, sometimes by throwing too much data, we've tried to minimize the amount of data. We haven't seen the dollars. All we've got to do now is just get more detailed data, throw the dollars at it, and watch the flow happen. But if you've got a picture of what's going on, then we'll in class, we'll get at some detailed questions and give you some practice at solving these sorts of questions. So that will do us for the moment. Let's just wait to build on that when we get back together in class. So looking forward to that, and we'll see you soon.